Hello, thank you so much for tuning in to Morning Markets. I'm Amber Canwar. We begin with our top story. Headline inflation in this country cooling to 3.1%. That's the lowest level that we have seen since June. Now, the biggest reason for the decline was a drop in gasoline prices. Things like rent, food prices, those continue to move higher. And yet, the market is betting that the Bank of Canada is done when it comes to increasing interest rates. And by this time next year, interest rates will be lower by nearly a full percent. Let's bring in Jean-François Perrault, Senior Vice President and Chief Economist at Scotiabank, and David Doyle on the desk with me, Head of Economics at Macquarie Group. David, I want to start with you. When you look at the details of inflation, clearly we're headed in the right direction. Is it enough to put the Bank of Canada on pause?
I suspect that will be the case, that they will be on hold from here. But I think it's a little premature, Amber, to be sort of ringing the till and declaring victory on the inflation side. I think that Governor Macklem, for instance, yesterday will still dangle out the possibility of further hikes. But I suspect the Bank of Canada won't act on that they are on hold from here.
Where does another reacceleration of inflation come from, do you think? Because it seems to be occurring at a time where signs are suggesting the economy is going to slow down. You know, that pent-up demand is starting to run off.
Yeah, I think that's exactly right. It's really hard to see where it could come from. You're seeing, real progress on disinflation, I think, in the data. I just don't think it's enough progress yet for the Bank of Canada to be declaring victory.
Jean-François, do you agree?
Yeah, to some extent. I mean, I think if you are, if we learn anything about inflation over the last year or so, is that it has tended to surprise on the upside. Now, we've had a couple of months where we've got good performance. That's fantastic. It's very welcome news, especially for households and the Bank of Canada. But I'd say that, the one kind of disconcerting element about the inflation report is that service inflation continues to accelerate. And we know that that's perhaps a little bit more tied to wage inflation, wage increases than the good side of the inflation equation. So, if you're looking for potential risks to inflation going forward, clearly the service side is not yet slowing to the extent that we would like. Now, there's some kind of peculiarities in there. And that, to our extent, to a significant extent, might be tied to the wage increases. So if we don't see wage moderation going forward, then there is going to be this kind of residual risk that inflation outperforms on the upside rather than on the downside going forward.
And yet there are signs of cracks in the employment picture. Certainly unemployment has started to tick up. Have the risks not increased that the Bank of Canada might over tighten if it responds to, that services picture that you're talking about?
Oh, certainly. I mean, we are clearly at a point where interest rates are hurting. There's no question about that. The economy is slowing. There's no question about that. There's a question about how fast the labor market is slowing. There still has been job creation, but unemployment rates are picking up, as you've indicated. So we are, there is accumulating evidence that inflation is going down, slowing, and the economy is as well. So certainly from the perspective of the Bank of Canada, based on what we've seen in the last few weeks, there is very little reason for them to move going forward. It's just a matter of risk management. If, we have a bit of a head fake on inflation and realize a couple months down the line that actually there is a return to inflationary pressures, we don't anticipate that. But again, inflation has been pretty difficult to model over the last year or so. So it's just a matter of caution and risk management. I think that would kind of keep them on the sidelines and have some language, as David suggested, that, they stand ready to act if inflation doesn't cooperate in the next several months.
And Jean-François, do you think that's the tone that Macklem will strike come tomorrow when he speaks?
I think so. I mean, he can't say anything other than he's mindful of the risk of inflation. I mean, inflation has come down. There's no question about it, but it's still pretty far from where he wants it to be. He'll be worried about the signal that he might send if all of a sudden everybody believes our rates are going to be cut in the not too distant future. I mean, markets have got a 50% cut price in for March, for instance. The lesson of last January, if you want to go back in time, is, when the governor indicated then that he was pausing, and so a lot of folks interpret that as being done, you had a resurgence, for instance, in the real estate market as folks anticipated cuts or stabilization of rates. So the governor is very, very mindful of that and will be very cautious about what he signals about the future path of interest rates for the next several meetings at the very least.
And yet, David, when Tip Macklem made the last Bank of Canada rate decision, I distinctly remember in the press conference, he said that the Bank of Canada could even consider pulling back on rates even before inflation gets to target. What was that about?
I suspect that he was speaking to the labor market on that side. And I think, we've already had the unemployment rate rise nearly a percentage point from its trough. So I think in an environment like we expect at Macquarie next year, where you have the unemployment rate approaching 7%, right, up another full percentage point or more from current levels, and you start to see some progress and you have the underlying inflation measures suggesting inflation might not be back to 2% yet, but it looks like it's going to get there in sort of 3 to 6 months. That could be the environment that causes them to start to talk about cutting rates.
We also heard from Bank of Canada Governor. He was pressed during that conference call, a press conference, I should say, about the fiscal side and fiscal matters. And I think he was maybe the most vocal he's been within his parameters about it's not helpful. Today, we will get that fall economic update. And while fiscal restraint is supposed to be on the table, so too are measures for housing affordability. How do you think about the fiscal picture and how that's all feeding into it, David?
Yeah, well, I think Governor Macklem was sending a not too subtle message to, the federal government and the provincial governments in his commentary, which was to suggest, if you want interest rates to stay where they are or to move lower, then you need to put the brakes on some of this fiscal spending. And I suspect in the fiscal update today, while you might get some additional measures targeting housing construction, the overall, picture will be relatively modest. You're not going to get some big, huge spending plans coming through.
And Jean-François, I guess that measures sort of targeting the housing picture would ultimately lead to, lower prices and could be deflationary. Is there anything more that the government could be doing to, further get to that deflationary or at least cooling inflation picture?
Oh, so certainly. I mean, we actually published a report on this late last week where we looked at the impact of government spending on economic activity in Canada on interest rates since the pandemic. So this is at the federal, provincial, and municipal levels. And we estimate that that spending behavior contributed about 200 basis points of the 475 basis point in increases that we've seen from the Bank of Canada. So there's no question that fiscal policies had a big impact on interest rates in Canada. Going forward, if you wanted to kind of scale back the extent of kind of fiscal engagement in the country, you would for sure contribute to a slower economic environment, and in so doing, reduce some inflationary pressure and probably make the Bank of Canada's job a little bit easier.
And let's leave with a sort of bottom line outlook. Jean-François, everything that you've said, everything that, put it all together in a nice tidy bow. When are you projecting the first rate cut, if at all?
We're expecting that next summer, and then about 100 basis points between next summer and the end of the year.
All right, kind of in line with market pricing. David?
So we'd be around the first time for the first rate cut, so call it June or July. But we would expect more significant easing in the second half of the year. We think you could see 200 basis points or more.
Due largely
to the rise in unemployment that we anticipate.
All right.